Welcome back, everyone, for part 3 of our discussion of chapter 3. We'll wrap this up with a few last slides talking about education expenses and a few other less common items. Savings bond interest, first of all. This is Series I savings bonds. We talked about Series E and EE earlier. These are specifically for education. And so if they qualify, now the hoops you have to go through to make sure that this works is pretty extensive, meaning the person who buys it has to fit the criteria, your income can't be too high, that sort of thing. When you get the interest from the bonds, then you spend it on qualified educational expenses that's more than what you don't either spend it all, or you end up having to pay more out of your pocket besides it. Then it could be exempt from income. All right, so there's a lot of hoops that you have to go through, but the theory is, if you go back to the example I gave earlier, someone gave you you have a bond, you bought it for $50, it pays out $100 as long as your educational expenses are more than $100. Then, and you fit all the other criteria, and your income isn't too high, then you could exclude that $50 that would normally be an income from tax. Starts to phase out when modified AGI equals 123,550 on a joint return and 82,350 for everyone else. And it phases out over a $30,000 period. So at 153,550 for married filing jointly, that it's gone, meaning you can't use it anymore. So that's that idea of phase out based on AGI. Reducing AGI would also allow this to work better for you. So remember that when we talked about the value of AGI last week. Below market interest loans, when you have no interest or very low interest in a contract, we've mentioned this briefly earlier, we have to pretend that there was interest at a market rate. This does not have to happen when the amounts are small enough or the payments are due in 6 months or less. All right, so again, you could have income where you don't actually receive it. What happens is you reclassify some of the money that you would have considered to be payment of the loan to the interest. So it's not as if you didn't get any money, right? It's just that the amount which you thought was interest, it could be higher because you have to impute interest. In cases where there's zero, or for instance, some paid off, then could be a gift, okay, gift loan. And if they make you loans within families or things like that, and they don't charge interest even though they should, and it's over $15,000, there could be interest income there. So the best way to get around that is just not make it a loan, make it just an outright gift. Now, a little bit about original issue discounts. When some borrowing is done, when you borrow, certain companies will issue what's called zero coupon bonds. They have an original issue discount. They work kind of like we talked about with savings bonds. The company will issue the bonds, meaning they'll borrow money from investors in this way. They'll say, okay, you give us $600 today per bond, and at the end of 20 years, we'll give you $1,000. So basically, we're giving you back your money plus $400 of interest. That $400 difference is the original issue discount, because when we did the transaction originally, it was $600 instead of the full $1,000. Now, you would say, okay, under savings bonds, technically you could wait and just record that $400 or have that income to you, to the investor, at the end, right? But that's not allowed in this scenario. So this is a situation where even if you're a cash basis taxpayer, which you should only record income when you receive it, this is a situation where that does not apply. You actually have to calculate interest each year or each 6 months or even each month, depending on how often it is paid out, okay, or calculated, compounded in the contract, and record it and take it as income, include it in your income, even though you're not going to see any of that money in cash until the very end. So what happens is you take that $600 that was borrowed, calculate the interest based on the interest rate, and that's added to the investor's income and added to the amount they receive. So if they loaned $600, then the company owes them $600 and they have interest on $600. You take that interest for year one, add it to the $600, and then recalculate the interest for the second year, and then include that much interest in income and add it to the $600 plus the interest from the first year to get the new balance that you'll use to calculate interest for the third year, and so forth. Now, fortunately, most of the time when you make an investment like this or you buy this in through a bank or other brokerage firm, they will send you a document showing how they calculated this, and so you don't have to worry about too much about the math of it. This does not apply to tax-exempt bonds that are issued or borrowing from, remember, school districts, states, local governments, U.S. savings bond that have different rules, Series EE bonds. If it's less than a year maturity, okay, it's way old, and it doesn't matter if the amount is $10,000 or less. So that's some, you might say, reprieve from this very specific detailed rule. It doesn't apply to everything.